ever feel like the world of fixed income is just this giant, like, puzzle, mysterious puzzle? I
Yeah,
think a lot of people do.
absolutely.
And that's why we're here today, to unpack an introduction to fixed income securities
Yes.
by Kizzi Nkwocha. And he's not just some random author.
Right. Right.
He's the publisher behind multiple finance magazines. So
Exactly.
he really knows what he's talking about, right?
Yeah, he really understands the needs of real investors,
Mhm.
what they're struggling with, what they're looking for.
And what I thought was really cool is that this book actually came about because he was talking to a multimillionaire.
Oh, really?
Yeah.
That's interesting.
And the multimillionaire was like, yeah, fixed income is like the cornerstone
Yeah,
of my portfolio.
which makes sense. It's all about stability, right? That predictable income stream.
Right.
You're not going to get those wild swings like you might with stocks,
Yeah.
where, one day you're up, the next day you're down. Fixed income, it's about preserving your capital,
Mm.
especially if you are a little bit more risk averse.
Right? Yeah. You don't want to be on that roller coaster.
Exactly.
So, okay. So that kind of sets the stage, right?
Yeah.
This idea of fixed income.
Yeah.
But then he goes into some really cool stuff.
Yes, he does.
Like, catastrophe bonds.
Yes.
I've heard of those.
That's right. And it's not just those, we've got peer-to-peer lending, this whole world of alternative investments that's opening up.
Yeah.
It's a really exciting time to be in fixed income, I think.
Yeah. Okay, so, like, what are we even talking about when we say fixed income securities?
So at the most basic level, a fixed income security is an agreement where you're lending money, right?
Yeah.
And in return, you get these regular, predictable payments.
Okay.
So it's that fixed income part that really differentiates it from, say, equities.
Yeah.
With stocks, your returns really depend on how well the company is doing, right?
Mm-hmm.
But with fixed income, you're getting that steady stream of income.
Right, so it's about that predictability.
Exactly. Predictability and stability. And that's what makes it so appealing for a lot of investors.
Okay, so I think most people, when they hear fixed income, they think bonds.
Yeah, they think bonds, bonds, bonds.
Bonds are like the classic example, right?
Yeah, and you can't really talk about fixed income without talking about the gold standard, I guess you could say, of bonds, government bonds.
Right.
And when you think government bonds, you think U.S. Treasury bonds.
Yeah, those are like the big ones, the benchmark.
Yeah, they are. They're considered a safe haven.
Right.
You're basically lending money to the U.S. government, and they're promising to pay you back with interest. And they're backed by the full faith and credit of the U.S. government. But, it's not just a U.S. thing.
Right.
German Munds, for example, they also have that reputation for safety and stability.
Okay, so you're essentially saying that because governments have the power to tax, they can basically always pay back their debts.
Right.
So it's seen as a very low-risk investment.
Exactly. It's seen as a lower risk investment compared to other types of investments, yes.
So that's the government bond side of things.
Yeah.
But then the book also delves into corporate bonds, which are a little different.
A little bit different. So with corporate bonds, it's a company, right?
Right.
That's issuing debt to raise capital.
Yeah.
And they typically offer higher returns than government bonds, but they also carry more risk.
So it's that trade-off, right?
Yeah.
Higher potential reward.
Exactly.
But also, more risk involved.
Yeah, because with a corporate bond, you're essentially betting on that company's ability to generate enough revenue to pay back its debt.
Yeah, because if that company goes bankrupt,
exactly,
that bond is worthless. Right.
Potentially, yeah. That's why it's important to understand the risks and also the potential rewards of corporate bonds.
And so this brings up credit ratings.
Right.
Yeah. Because when you're talking about corporate bonds, how do you know?
That's a great question, and we'll definitely get into that in a bit.
Okay.
But credit ratings are basically a way to assess how likely a borrower is to default.
Right.
So it's kind of like a report card for borrowers.
Okay.
You've got agencies like S&P, Moody's, Fitch. They're kind of like the teachers grading these students,
Okay, so like AAA would be like the A+ student.
Exactly. AAA is the highest credit quality, so very low risk of default.
Okay.
And then as you go down the alphabet, the risk increases.
Okay, so BB would be like a C student.
Yeah, maybe a C or a B student. Yeah.
Risky, but maybe worth a gamble.
Well, there you go. You're starting to think like a fixed income investor. But always remember, credit ratings. They're just opinions.
Oh, so they're not like...
Not guarantees, no.
Got it.
Even the best agencies can get it wrong sometimes.
So you can't just blindly rely on those credit ratings.
Well, exactly.
You have to do your own research.
Absolutely.
So, okay. So that's kind of like the basics, right?
The basics, yeah.
You know, government bonds, corporate bonds. But then he goes into all these other types of fixed income.
Yeah, he does.
Which are super fascinating.
Yeah.
So, for example, municipal bonds.
Yeah.
Those are issued by, like, state and local governments.
That's right.
To fund different projects.
Exactly. Schools, hospitals, roads, you name it.
And here's the cool part for us U.S. listeners.
Yes.
They can potentially offer tax-free income.
It's true. It's a big draw for a lot of investors.
Yeah. Who doesn't love a tax break?
Exactly. But of course, you have to do your research.
Right.
You got to understand the issuing municipality's financial health.
Right. So it's not just about the tax benefits.
No.
It's also about...
It's about making sure that municipality is in good shape.
Is in good shape.
Okay.
Financially. Right. Okay. Then we got these mortgage-backed securities, or MBS.
Yeah.
Now, those sound a little bit more complicated.
They can be, yes. So imagine taking a whole bunch of individual mortgages,
Okay.
bundling them together, and turning that bundle into a tradable security. That's basically what an MBS is.
Okay, so instead of investing in one single mortgage,
right,
you're investing in like hundreds.
Yeah, it could be hundreds, could be thousands.
Thousands of mortgages, wow.
Exactly.
And Fannie Mae and Freddie Mac.
Yeah.
They're involved in this, right?
They are. They're big players in the MBS market. They buy mortgages from lenders, bundle them up into those MBS, and then guarantee them.
Okay.
Which helps to keep the mortgage market flowing smoothly.
Yeah.
Makes it easier for people to buy homes.
But there are different types
There are.
of mortgage-backed securities, right?
Yes.
Like pass-throughs,
Yeah.
CMOs. What are those?
So those are different ways of structuring those mortgage pools.
Okay.
Pass-throughs are fairly straightforward.
Yeah.
Those cash flows from the mortgages just go directly to the investors. But CMOs, collateralized mortgage obligations, they're a bit more complex.
Yeah.
They divide those cash flows into different tranches.
Okay, so like different levels.
Different levels, yeah.
Okay.
And that can have a big impact on the risk and return of that MBS.
Interesting.
Yeah.
And then on top of that, we've got asset-backed securities. So that's not just mortgages. That's like...
That's right. Asset-backed securities, or ABS, they're backed by any pool of assets that generates that predictable cash flow.
So it could be auto loans?
It could be auto loans.
Credit card receivables?
Yep. Credit card receivables, student loans, you name it.
So basically, you could take anything that generates income, bundle it together, and make a security out of it.
That's the idea.
Yeah.
And it opens up all sorts of possibilities for investors.
Okay, so we've got all these different types of fixed income securities.
Right.
And now I'm kind of wondering, like, how do we actually make sense of all this?
That's the key question, right? It's not just about what fixed income is, it's about how it works.
Yeah. Like, what are the key concepts that we need to grasp to actually use this knowledge?
Absolutely.
So maybe we could start with one of the most fundamental concepts.
Yeah.
Maturity dates.
Yeah, maturity dates. That's a great place to start. So maturity date is basically the date when you get your principal back.
Okay.
It's the end of that investment term. That's when the issuer has to pay back that initial investment.
Got it. So, like, it's kind of like setting a timer on your investment.
Exactly.
And that maturity date would, like, obviously impact your investment strategy.
Oh, absolutely.
Right.
Yeah.
Like, if I'm saving for a down payment on a house in a couple of years,
right,
I wouldn't want to tie up all my money
exactly
in a bond that matures in like 30 years.
Exactly. You need to match your investments to your time horizon.
Right.
Are you looking for short-term gains or are you looking for long-term growth?
Okay. So maturity dates, check.
Yeah.
Now, let's go back to those credit ratings.
Yeah.
How can we actually, like, use those to make smarter decisions?
So credit ratings, they give you a good sense of the issuer's ability to repay their debt.
Okay.
They're kind of like a gauge of their creditworthiness, Helps you figure out, okay, how risky is this bond?
And we were talking earlier about, S&P, Moody's, Fitch.
Yeah, the big three.
They're the ones that are issuing credit rating,
well,
right?
Exactly.
And they all use these different scales.
Yeah, they do. Slightly different scales, but it's the same basic idea. AAA, that's your top notch.
The best of the best?
The best of the best. Very low risk of default. And then as you move down that alphabet, that risk increases.
But, like we said, It's important to remember that they're
opinions, not guarantees.
Opinions, not guarantees.
That's key.
Yeah.
They do their analysis, they make their judgments, but they can be wrong sometimes.
Yeah, so you can't just blindly trust those ratings.
No, no.
You got to do your own homework.
You got to dig deeper.
Right.
Look at the company's financials. Think about their industry.
Think about the overall economy.
Exactly.
Right.
That all plays a role.
Okay, and then of course there's yield, which is the return that you get on your investment.
Yeah, yield is essentially how much you can expect to earn from that fixed income security.
And it feels like all those things we just talked about, maturity dates, credit ratings, risk, it all kind of comes together when you're talking about yield.
Oh, it does. Yeah, they're all interconnected.
So for example, a high yield bond might sound really tempting.
Right.
But it's probably got a lot of risk associated with it.
It could.
Right.
It's that trade-off,
yeah.
Risk versus reward.
So how do you know? It's is it genuinely a good investment?
That's the million-dollar question, right? You got to figure out, why is this bond offering this particular yield?
Right.
Is it because it's genuinely a good deal?
Yeah.
Or is it, a red flag?
Yeah. Okay, so that kind of covers the what of fixed income.
The what?
Different securities, ratings, yields.
Yeah.
What about the how?
The how, that's the next level.
Right. How can investors actually actively manage their fixed income?
Right. How can you take control of your investments? How can you potentially boost your returns?
And one of the concepts that the book talks about is hedging with derivatives.
Hedging, yeah.
Derivatives always sound kind of
intimidating.
Intimidating.
They can be, yeah.
So can you demystify them a little bit for us?
So think of derivatives like financial instruments that piggyback off of another asset.
Okay.
So their value, it's derived from that underlying asset.
Okay.
And in the fixed income world, derivatives can be really useful for managing risk.
Okay.
Particularly interest rate risk.
And interest rate risk, that's if interest rates go up,
right,
the value of my bonds is going to go down.
Exactly. That's the risk.
Right.
You're worried about those rates rising, eroding the value of your fixed income investments.
So you're saying there's a way to protect yourself from that?
Potentially, yes.
Okay, how?
Well, one way is to use interest rate futures. These contracts, they let you lock in a future interest rate.
Okay.
So you're essentially hedging against those adverse movements.
So it's kind of like I'm taking out an insurance policy.
You could think of it that way.
On my bonds.
Yeah.
But instead of protecting me from damage.
Right. Not from fire or theft.
They're protecting me from
those interest rate swings.
Okay.
Exactly.
Now, the book also mentions options on futures.
Yeah.
Those sound even more...
complex.
Yeah.
Complex. A bit more. Yeah. So options, they give you the option, but not the obligation to buy or sell that futures contract at a certain price.
Okay. So it's more flexibility.
And more flexibility, yeah.
But futures are maybe a little more straightforward.
You could say that. Choosing between the two really depends on, what your goals are and how much risk you're willing to take on.
Okay. Now, another strategy he talks about is immunization.
Immunization.
It sounds like you make your portfolio immune to risk.
A vaccine for your portfolio. Well, not quite, but the idea is to minimize that interest rate risk.
Okay.
And you do that by matching the duration of your assets to your liabilities.
Okay. He used this really good analogy of a well-fitted suit.
Yeah, I like that one.
Where the sleeves align perfectly.
You're trying to achieve that balance.
Yeah.
So those interest rate changes, they don't really rock the boat too much.
Okay, so let me see if I understand this.
Yeah.
If I have a big expense coming up in 5 years.
Okay.
My kid's college tuition.
A big one, yeah.
Yeah.
For a lot of us.
Yeah. I would want to hold bonds that also mature around that same time.
Exactly. You want to match that maturity to that liability.
So then I don't have to worry about selling those bonds at a bad time.
You're reducing that risk.
Okay.
Yeah.
Got it.
You're becoming quite the fixed income strategist.
Yeah, I'm learning.
I like it.
But then there's also reinvestment risk, which seems like a totally different challenge.
Reinvestment risk, yeah. So that's the risk that you have to reinvest those coupon payments at lower rates than you initially earned.
So let's say I buy a bond.
Okay.
That's got a 5% coupon.
Okay.
But then interest rates drop to 3%.
Uh-oh.
I'm kind of stuck reinvesting that money at a lower rate.
That's the risk, yeah.
So how do you combat that? Is it diversification again?
Diversification is always a good tool. Spreading your investments across bonds with different maturities, different coupon rates, that can help.
Okay.
Yeah.
And, we've been talking a lot about the U.S.
Yeah.
But this is a global market.
Oh, it is. Fixed income. It's global.
So what about all those opportunities in other countries?
Right. In Nkwocha, he talks about global fixed income markets and all the potential there.
Give us some examples.
Yeah, so like emerging market debt, that can offer really high yields.
Okay, so higher reward.
Higher rewards, but also potentially higher risk.
Higher risk, yeah.
You got to be comfortable with that volatility.
Yeah.
And there's always the currency risk too.
Right, because if the value of that currency changes,
Right.
that impacts your returns.
That's right. It can make things a bit unpredictable.
Yeah, okay. What about investors that are like,
Right.
really into sustainability?
Yeah, that's a growing trend, and there are definitely options in fixed income.
Like what?
Well, Nkwocha talks about green bonds
Oh, yeah.
and sustainable fixed income investments.
So those are like bonds that are...
Right, specifically for projects that have environmental benefits.
So I could, support renewable energy projects
Exactly.
and still get a fixed income.
You got it.
That's really cool.
Yeah, I think it's really exciting to see how the market is evolving,
Yeah, totally. Okay, we've covered so much in this dive into fixed income essentials. But one that we haven't really dug into is credit risk.
Credit risk. Oh, yeah, that's a big one.
And I think Nkwocha really emphasizes that. That's something that every fixed income investor needs to be aware of.
Absolutely. I mean, no matter how good that yield looks, if the borrower can't repay their debt,
Yeah.
you're at risk.
You could lose money.
You could.
Yeah. Okay, so we talked about credit ratings.
Yeah.
But you're saying that's not enough.
It's a good starting point.
Yeah.
But you can't just rely on those letters.
Right.
You have to do your own digging. You
Yeah.
got to understand what's driving that issuer's creditworthiness.
So how do we actually do that?
Well, it's a multifaceted process, right?
Okay.
You got to analyze their financials, their industry, their competition, even the broader economy.
And the book goes into
Yeah.
some pretty in-depth analysis.
It does. Financial statements, cash flow analysis.
Is that something that the average investor can even do?
It can seem daunting, but there are resources out there.
Okay.
And remember, you don't have to be a financial wizard
Yeah.
to ask the right questions.
Right. Is this company making money?
Exactly.
Do they have a ton of debt?
Those are the key questions.
Are they in a good industry?
Yeah, is that industry stable? Is it growing?
Okay.
You know.
So you're saying it's go beyond the numbers.
Absolutely. And in Nkwocha, he has this great story about a trader named Mark Cohen.
Okay.
And it really illustrates this point.
Tell me about Mark Cohen.
So Mark, he was a really successful trader.
Okay.
But he kind of dismissed credit derivatives, thought they were too complicated.
Yeah.
He was sticking to the old school methods.
Okay.
But then he had this close call.
Oh.
Yeah, almost lost a lot of money.
Okay.
Because of this unexpected credit event.
Mm. So he realized he needed a better way.
He needed a better way.
To manage risk.
To manage risk, yeah. So he decided to really dive into the world of credit derivatives.
Yeah.
Learn how they worked, how he could use them to his advantage. Well, he started incorporating them into his strategies, and he realized they could actually help him, not just mitigate risk, but actually boost returns too.
So how do credit derivatives work? What was Mark's big strategy?
His aha moment came when he started using something called a credit default swap, or a CDS.
A credit default swap. That sounds kind of intense.
They can be complex, yeah, but the basic idea is pretty simple.
Okay.
Imagine you have a bond issued by company A,
Okay.
and you're a little worried about their creditworthiness.
Okay.
So you buy a CDS contract that references that specific bond.
Okay.
Now, if company A defaults, the seller of that CDS has to compensate you for your losses.
So it's like an insurance policy.
Like an insurance policy.
For that bond.
Exactly.
Yeah.
And that's what Mark realized. CDS could be his safety net.
Okay.
He could take on more credit risk without, risking everything.
But you're saying CDS aren't just about hedging?
No, they can be used for speculation too.
So I could, bet
Yeah.
on whether a company's creditworthiness is going to go up or down.
You could?
Wow. Okay, that sounds pretty advanced.
It is.
And probably not for,
No.
the average investor.
You need to know what you're doing.
Yeah.
It's a powerful tool.
Okay, so we've got CDS, which are focused on single bonds.
Yeah.
And then he also mentions these things called CDOs.
Collateralized debt obligations.
Collateralized debt obligations. Are those, related to credit derivatives?
They are. So CDOs are these structured financial products
Okay.
that pool together different types of debt mortgages, auto loans, credit card receivables, even corporate bonds.
So it's like instead of insuring a single bond,
Right.
it's like a
A
bundle
bundle of debt.
of different types of debt.
Yeah, exactly.
That's all packaged together.
All packaged together. And just like with MBS, they're divided into those different tranches based on their risk levels.
So you got like the safe ones that pay out first but have lower yields.
Right.
And then like
the riskier ones.
The risky ones with higher potential return.
Exactly. It's a way to slice and dice that credit risk.
Okay, but CDOs, did those play a role?
Oh, they did.
In the 2008 financial crisis?
Yes. They did, yeah. Their complexity, the lack of transparency in the market.
Yeah.
It was a recipe for disaster.
Yeah. Okay, CDOs, powerful.
Powerful.
But definitely approach with caution.
Definitely approach with caution.
He also mentions credit-linked notes, or CLNs.
CLNs, yeah. So those are structured products that combine a bond component with a credit derivative.
Okay, so they're kind of like
the hybrids.
Hybrids.
Blending the best of both worlds.
Yeah. Okay, so you can really tailor those to specific investor needs.
Yeah.
Risk tolerances.
Absolutely. The fixed income market offers so much flexibility.
Yeah. It's fascinating. But we still have a lot to cover. I know Nkwocha goes into some other interesting instruments.
He does.
Beyond credit derivatives.
He does. Like callable bonds, for example.
Callable bonds. What are those?
So those give the issuer the right to buy back the bond before its maturity date.
So like if I buy a 10-year callable bond, they could just like decide to pay me back early.
They could.
Why would they do that?
Usually it's when interest rates have dropped.
Oh, right.
They can refinance their debt at a lower rate.
But that kind of screws over the investor, right?
It can be a downside.
Yeah.
That's why callable bonds typically offer higher yield.
Okay, so it's like you get compensated.
You get compensated.
For that risk.
Exactly.
Okay, higher yield, but
with the potential for early redemption.
Yeah.
What about inflation-linked bonds?
Inflation-linked bonds, those are designed to protect you from inflation.
Okay, so if inflation goes up,
yeah,
the principal value of my bond goes up too.
That's right. So your purchasing power is protected.
Okay, and the interest payments are based on that adjusted principal.
Exactly. So you get more income as inflation rises.
That's pretty cool.
Yeah, especially in times like these when inflation is a concern.
Okay, we're running out of time for this segment, but I want to touch on one more thing.
Yeah.
Yield curve analysis.
Ah, the yield curve. This is where things get really interesting.
Okay, so the yield curve, that's just like a graph. Yeah, it's a graph that shows the yields of bonds with different maturities.
And you can look at the shape.
The shape tells a story.
Of that curve.
It does. It tells us about market expectations, economic trends.
Okay.
You know, what's the sentiment out there?
So what are like the different shapes and what do they mean?
So you got your normal yield curve that's upward sloping. Longer term bonds have higher yields. Typically means people are expecting growth, maybe some inflation. Yeah. But then you can have a flat yield curve.
Flat yield curve.
Yeah. Not much difference between short-term and long-term yields. That might signal some uncertainty.
Okay.
People are hesitant.
That guy.
And then you've got the dreaded inverted yield curve.
A dreaded inverted yield curve. That sounds bad.
It can be. Short-term yields are higher than long-term yields.
Okay.
That's often seen as a recessionary signal.
So we got to keep an eye on that yield curve.
Absolutely. It's a valuable tool for any fixed income investor.
Okay, so we've covered a lot in this segment. Credit risk, credit derivatives, yield curve analysis. I think we've all learned that fixed income investing is a lot more than just buying and holding bonds.
It is. There's so much depth, so much nuance.
And speaking of nuance, I think it's time to revisit mortgage-backed securities, or MBS.
Yes, MBS. They deserve a deeper dive.
We'll get into all the intricacies
of ins and outs
of MBS in our next segment, so stay tuned. Okay, so we're back, and we're diving into one of the most, I don't know, maybe misunderstood corners of the fixed income market, mortgage-backed securities.
Yeah, MBS. They definitely have a reputation, don't they?
Yeah, I mean, everyone remembers 2008.
Right.
You know, all the talk about, like, toxic assets and all that.
Yeah, they definitely got demonized a bit.
But I think a lot of people still don't really understand what they are.
Yeah, how they work.
So let's unpack that a little bit.
Okay, sounds good.
So big picture, what's an MBS?
So remember, it's basically a pool of mortgages all bundled together.
And then turned into this tradable security.
So instead of investing in one single mortgage, you're investing in like a piece of
Yeah.
Hundreds, maybe even thousands.
Thousands, yeah.
Of mortgages.
Exactly.
And we talked earlier about Fannie Mae and Freddie Mac.
Yeah, the big players.
They're involved in this, right?
Oh, they're huge in the MBS market. So they buy those mortgages from lenders, package them up, and then they guarantee those MBS.
Okay. And that helps to make the mortgage market more liquid, stable.
Stable,
yeah.
Yeah, it's all about keeping that money flowing.
Right. Okay, that's a good refresher on the basics.
The basics.
But what always gets me are the different types of MBS.
Right, there are a few different flavors.
Yeah, so what are the main categories?
So you've got your pass-through securities. Those are probably the simplest.
Okay.
Those mortgage payments. They just flow right through to the investors.
So, like, if I'm holding a pass-through MBS...
And a homeowner makes their monthly payment.
Yep.
Part of that payment goes to me.
Exactly. It's a pretty straightforward, transparent system.
Okay. But then there are CMOs, collateralized mortgage obligations.
Right. Those are more complex. They take those mortgage cash flows and divide them up
Okay.
into different tranches.
Bunch of tranches. Okay.
Yeah.
So imagine like we've got a cake.
Yeah.
Each tranche is like a different slice.
Different slice of cake.
Some slices are bigger, some are smaller.
Some have more frosting.
Some have more frosting. Exactly.
Right. And that frosting, that's the risk and return.
Okay.
Some tranches are going to be more stable, maybe lower yield. Others more volatile, but potentially higher return.
Got it. So the CMOs are kind of like a multi-level marketing scheme.
Whoa. Careful now.
No, bad analogy.
Good analogy.
Okay, but seriously, it sounds like you really got to understand
Oh, you do?
the different tranches to make sense of MBS.
Yeah, it's key to understanding the risks and rewards involved.
Okay, so let's talk about those risks.
The risks, yeah.
Because MBS has some unique risks.
Unique risks, yeah.
Right.
Absolutely. One of the biggest ones is prepayment risk.
Prepayment risk. So that's like what the risk that people pay off their mortgages early?
Exactly. And that can really mess up your plans.
Yep.
You're expecting those steady payments.
Yeah.
Nice and predictable.
Right.
But then suddenly people are refinancing, selling their homes.
Okay.
And that cash flow, it gets all jumbled up.
So if interest rates drop, for example.
Right.
And everyone's like, oh, I'm going to refinance my mortgage.
Go to stampede to the bank.
That could be bad news for MBS investors.
It could be, yeah. You get your principal back sooner.
Yeah.
But then you got to reinvest that money at lower rates.
So it's not just about the risk of default. It's also about the risk that things go
too well.
In
the housing market.
Yeah, exactly.
Mm.
Okay, so how do investors deal with that?
Well, they use prepayment models. Trying to predict, how fast those mortgages are going to get paid off.
Okay.
There's the single factor model, which is pretty simple.
Okay.
Mostly focuses on interest rates.
And then there are more complex models.
More complex, yeah. Multi-factor model that takes into account things like credit scores, loan-to-value ratios, even economic conditions.
So it's trying to, predict human behavior.
It is. When are people going to move? When are they going to refinance,
Yeah. But even the best models can't predict everything.
Oh, no. It's not a crystal ball.
People are unpredictable.
Exactly.
Okay, so prepayment risk check.
Yeah.
What other risks do we need to be thinking about?
Well, credit risk is another big one. Remember, these MBS, they're backed by those individual mortgages. Yep. So if homeowners start defaulting, that impacts the value of that MBS.
So it's just like with corporate bonds, you got to think about the credit worthiness of those borrowers. Okay, and the credit quality of those mortgages.
It can vary. You got your prime mortgages, subprime mortgages, all sorts of stuff in between.
And those subprime mortgages, those played a big role in the 2008 crisis, right?
They did. Lots of MBS were packed with these subprime loans, mortgages given to borrowers with, not so great credit.
Yeah.
And when housing prices tanked, people started defaulting.
Yeah.
It was a mess.
Okay, so we got prepayment risk, credit risk.
Yeah.
I'm starting to see why MBS can be
a little tricky.
Yeah, a little tricky.
Yeah, you got to be careful.
But like you said earlier, they can also offer attractive yields. Diversification benefits.
Diversification, yeah. It's all about understanding the risks and then managing them.
So if I'm an investor and I'm like, okay, I'm interested in MBS.
Okay.
What are some strategies?
Yeah. Well, diversification is always a good place to start.
Right.
Don't put all your eggs in one basket. Spread your investments across different types of MBS, different issuers, different tranches.
And what about actively trading MBS?
Trading, that's a whole other ballgame. It's fast-paced, complex, probably not for the faint of heart.
Okay, so maybe leave that to the pros.
Probably a good idea, yeah.
But the book does talk about some trading strategies,
It does.
right?
Yeah, Nwosha talks about relative value analysis.
Relative value analysis. What's that?
So you're basically comparing different MBS,
Okay.
looking at their pricing, their yields, trying to find those little hidden gems.
Okay, so it's like being a
A detective.
in the MBS market.
Looking for those undervalued or mispriced opportunities.
Yeah. Okay, so
MBS
complex, but potentially rewarding.
Yeah. And then just to add another layer of complexity,
Oh, yeah.
he also talks about asset-backed securities, or ABS, which are even broader than MBS, right?
Broader, yeah, ABS, that's a whole universe of assets, not just mortgages.
Yeah, for auto loans, credit card receivables, student loans.
Equipment leases.
Equipment leases, yeah. Anything that generates that predictable cash flow.
So you're taking those assets,
Right.
you're pooling them together,
Pulling them together.
and then making a security.
A security backed by those assets.
Yeah.
Yeah.
And I'm guessing, just like with MBS,
Just like MBS.
you get different tranches,
Different tranches.
different risk levels.
Absolutely. So investors can choose, the level of risk they're comfortable with.
Wow. Okay, so we've covered a lot in this deep dive
We have
into fixed income.
from bonds to yields to credit risk to derivatives, MBS, ABS.
Yeah,
It's been quite the journey.
it has been. And I feel like
Yeah.
an introduction to fixed income securities has been a great
A great guide.
for us.
A roadmap through this complex world.
Yeah, it's comprehensive,
Comprehensive?
but also really engaging.
Engaging.
Like, I learned a lot, but I didn't feel like I was reading a textbook.
No, not at all.
So, yeah, highly recommend it.
That-
To anyone that's
Yeah.
looking to really understand fixed income.
To demystify it
Yeah, demystify it.
and take control of their investments.
Well, on that note, I think we're going to wrap up this episode
Yeah.
of the deep dive.
Time flies when you're talking fixed income.
It does.
Yeah.
But as always, we encourage you
Yeah.
to keep exploring, keep learning.
Keep that curiosity going.
And until next time, happy investing.